Alright, nice. Hello. Welcome back to day 31 of trying to be a great investor. So, it's fully been a month now. Pretty exciting. And I'm currently visiting my sister at LA, so I'm at her school right now at UCLA. This is the first time I'm here. Damn, this building is nice as fuck. It's so much better than where I go to school. But today I'm probably gonna read through some of the newsletters from Howard Marks. I think I got an email from Oaktree saying that he has a new newsletter on credit, so that'll be interesting to take a look at. Let's see what else is there. Oaktree Insights, and then maybe go through some articles from the Wall Street Journal just to catch up a little bit on what's going on with the markets and what's going on with some of the company earnings. I think a lot of companies report their earnings, especially a lot of financial institutions this week and last week, so it'd be good to see what's going on with that. And then lastly, I brought some textbooks with me, so might read through some of the chapters on navigating big debt crises by Ray Dalio. So I think that's probably going to be the schedule for today, and then I'm going to go eat lunch. After lunch, probably work on the discounted cash flows model for VF Corp. Still haven't finished that yet, so I'm kind of sad that it's taking a while. But kind of interesting to see what this is. Read it now. Okay, it's actually not that long. Then maybe I'll go back to the one by Howard Marks as well. Alright. The current environment for credit investors is the most attractive since the global financial crisis, based on the north side of today's market. So I read somewhere that's right now I think there's a record amount of cash held in money market funds and also in just regular deposit accounts, so that's savings or checking accounts. And maybe that's something to think about when I read through this article. It's the sheer enormity of the market right now. We're thinking about the addressable market for opportunistic credit in 4 buckets: high yields, triple-B rated bonds, leveraged loans, and private credit. Okay, so defaults and losses are likely going to tick up in the broad market over the next couple of years. Okay, maybe probably due to high interest rates, slower consumer spending, growing risk related to floating rate borrowers. Yeah, I totally forgot about floating rates borrowers. They're probably going through it right now. US high yield bond leverage issues. There's only 1,500 US high yield bond leverage issues. Put together a portfolio of hundreds of broadly syndicated loans and high yield bonds. Spreads have been a little bit tired, but with base rates where they are, private credit firms can potentially earn 11.5 or 12% coupons while lending to multi-billion-dollar businesses. Sponsors were 6%, 7% total capital. This is a very attractive risk-adjusted return. What's the syndicated market? I'm not too sure. The acute area of risk right now is commercial real estate. Alright, so occupancy rates are still low compared to pre-pandemic levels, I think. Saw a nice rally in duration during late 2023. 10-year Treasury yield hit a high of about 5% in October, then fell back down to close at 4% in less than 6 weeks. Okay, interesting. Insights. Education. Okay, so there's a few things I'm curious on. I should probably sign into TiddlyHost real quick. Week 5. So today is Tuesday. What? Oh no, today's Thursday actually. Thursday, January 6th, 2024. So, here's newsletters. Read. And also, I think read newsletters. Then also work on, maybe write a little bit. The reports. And also maybe place some limit orders. So I'm gonna put VFC, DC. Okay. Add new interstitial shell now. January 18th. There's the January 18th. Reading Howard. Tree sets. Coordinates. Saying follow-up sites. I feel like there's gotta be types of reports, helpful resources. Skipper app. Things to learn. Need to add this. Okay, so syndicated loan. Oh, yeah. Syndicate. Syndicated loan is a loan extended by a group of financial institutions. Syndicated loans include both bank and non-bank financial institutions, such as collateralized loan obligation structures, insurance companies, pension funds, or mutual funds. Quarterly reports of the Shared National Credit Program. Okay, so it seems like a syndicate is just a group of lending institutions. It could be banks, financial institutions, insurance companies, pensions, mutual funds. And a syndicated loan is just a collection of loans from these different institutions that then are lent to a single organization. So it's master deck. Okay. So when it creates a deck called credits, and maybe within it creates what is a loan syndicate. So a loan syndicate is a fancy name for a group of financial institutions that will make loans to a single organization. So an example would be a group of banks, pension funds, insurance companies that together make loans to a company. Alright, this should be the main idea. Send it by. Syndicated loans can be traded in the secondary market. So I wonder where they are though. Oops, not Discord. I wonder where they're traded. So bigger banks, pension funds, insurance companies that together make loans to a company. So what is a syndicated loan? A syndicated loan is a loan that is extended by a single company to a single company / entity from a loan syndicate. So this a collection of lenders. Okay. What is a leveraged loan? Okay, I'm assuming what they mean right here is they didn't syndicate originate, so they can originate being the sole originator or the sole owner of the debt, or they can syndicate a loan so they can work together with different institutions to provide a single loan package to, or maybe a collection of loans. Trees are going to start to ramp up over the next several years in a very meaningful math fashion. You have over 800 billion of US high yield bonds. You know, I feel like training an AI model to be able to predict whether or not, I feel like that could be easier on credits versus equities, trying to predict the default risk of certain companies. So leverage loans. Okay, this is nice. This is cool. It is first structured, arranged, and administered by one or several commercial investment banks known as arrangers. It is then sold or syndicated to other banks. Institutional leverage loans can be referred to as senior secured credits. LCDs leverage. Okay, I'll watch this video real quick. Let's see, Bluetooth, connect sound, outputs, Brian's AirPods. All right. Okay, nice. Sure, look at this.
You may have heard of the term bank loan before. Well, that's kind of a misnomer these days because the big banks aren't really making big corporate loans in the way that they used to. These days, they're more likely to arrange those loans and then divide them up amongst investors. And today, these loans are called senior secured loans. And to show you how they work, I want you to imagine the interior of an aircraft. In fact, imagine you're booking your flight and choosing your seat. You've got the whole map of the plane laid out, and depending on which ticket you've bought, you get to choose your seat in certain sections. Now, equity and debt instruments are a bit like airline tickets. Depending on which class of ticket you buy, you're going to get treated a certain way. Oh, thanks very much. And when it comes to getting off the plane, you're going to get off in a certain order. Shareholders, both ordinary and preferred, are all the way back in economy and economy plus. They can expect a volatile, bumpy flight. Bondholders get treated better, just like business class passengers. And up there in first class, the senior secured lenders. But why is it that bondholders and senior lenders get treated so much better than shareholders? Well, quite simply, it's because the company owes them money and has to make an interest payment to them every month. Now, if something goes badly wrong with the company, all of these investors are going to want their money back. But just like passengers trying to get off an aircraft all at the same time, not everybody's going to get paid out at once. The people who get paid back first are those valuable senior lenders. Just like first-class passengers, they are prioritized. Next to get off and get paid, the bondholders. And finally, the shareholders. They are the last people to recoup their investment. Well, so much for senior. What about secured? Secured means that the loan is backed by collateral. That could be assets in the company, or it could be part of the company itself.
Okay. I'll keep watching. This is a pretty good analogy so far.
If it comes to a liquidation. But the combination of seniority and security mean that these loans are much less risky, and the lenders will probably get all or most of their money back if things go really badly wrong with the company. I say probably because senior secure lenders can still suffer significant losses. I mean, for example, if a company's entire business model goes down the tubes, like with VCRs back in the day, well then everybody's going to lose. It's all about risk and reward, right? A company's senior secured loan is less risky than its bonds, which is why the loan pays less in interest. In the same way, a big, safe, blue-chip company's debt pays out a lot less in interest than a senior secured loan, because companies that issue senior secured debt tend to be riskier. They might operate in highly cyclical or uncertain industries, or they might be carrying a lot of debt. Now, it's worth noting that a lot of the companies that issue senior secured loans are owned by private equity firms. Now, these companies are risky, which is why they have to offer high rates of interest in order to attract all of their lenders. But let's not forget that these lenders want those high interest rates. They want those yields. So they're willing to accept the risk of a little bit of turbulence. And the seniority and the security in a senior secured loan, well, they're just like two big old cushions designed to give those senior lenders a more comfortable ride. These are comfortable.
I like this guy, Patty Hirsch. An author. Okay, people seem to like it. That's cool.
So what is leveraged finance? Well, it's right there in the name. It's when a corporate acquisition is financed using leverage. In other words, it's when a company is bought using debt. And I'm not talking about a little bit of debt here. I'm talking about serious amounts of debt, like billions of dollars. Sorry about that. Anyway, pretty much anybody can use leverage finance for an acquisition. A company might use it to buy anything from real estate to a rival, or you might find corporate officers at a company using it to effect a management buyout of the corporation. But probably the most frequent use of leverage finance these days is when a private equity firm uses it to buy a company. So let's focus on that one. And let's meet our private equity player, also called a sponsor. This one's name is Sheila. Now, her firm doesn't usually have that much money to spend, and the company the firm wants to buy could be enormous, like billions of dollars. Now, let's say this business is valued at $10 billion. Sheila's private equity firm can only afford to put up $2.5 billion, which means they need to find $7.5 billion from somewhere. What are they going to do? They're going to borrow that money. And where do you borrow money? From a banker. This is Billy the banker. Now, these days, banks don't lend anything like that kind of money. Instead, they provide certain services. They act as a conduit between the borrower, the private equity firm, and a bunch of other investors who want to lend to the firm. Now, this is called arranging a loan. The bank might also commit to underwrite the loan. This is when it guarantees that the private equity firm is going to get the money it needs, even if the bank has to dig into its own coffers to make that happen. The bank might also commit to arranging a bond issue to go alongside the loan, to increase the variety of investors that are involved. Frankly, anything they can do to get this deal done. Now, Billy the banker gets paid handsomely for providing these services. It's a lot of work, but there's very little risk. Unlike being the actual lender, where there's the risk you might not get paid back, especially when the borrower is carrying a huge amount of debt. Now, that debt is serious baggage, and it's not the private equity firm that has to carry it, it's the company they bought. It now has to do business as usual, carrying $7.5 billion in debt. Now, in a situation like this, bankruptcy is a very real possibility, but if you're willing to take the risk and the company remains good on its obligations throughout the duration of the deal, you stand to make some serious money. And if you invest in the loan part of the deal, well, you're maximizing your protection, which means that you're going to get a relatively small amount of interest. But if you invest in the bonds, you're taking more risk, which means, of course, you're going to get a greater return. Now, it can be years before the private equity firm actually sees any money on a deal like this. And until that happens, it has to operate the company. And that means managing that huge amount of debt. That's a pretty tall order. And sometimes it can lead to some very deep cuts in the company. Sometimes it means selling off some of the company's operations. The plan is to get the company to the point where it can be sold, maybe to the public or maybe to another corporation. So let's say the private equity firm manages to sell this company for $15 billion. Not bad, right? Because they bought it for 10. But unfortunately, $7.5 billion of that dollars goes right out of the door, right? Because it's got to go back to those lenders, leaving a balance of $7.5 billion. Of course, the good news is that that $7.5 billion belongs entirely to the private equity firm. So what's happened? The private equity firm has managed to turn a $2.5 billion investment into $7.5 billion. That's a 300% return on investment. So it's no wonder that private equity firms are so willing to take this kind of risk. And there is a risk, because if they fail to return that $7.5 billion that they borrowed to the lenders take possession of the company. And that includes the $2.5 billion initial investment made by the private equity firm. And if that happens, it's going to leave our private equity pals very badly, needing a drink.
Okay, so I like how Patty explains the idea of seniority and how different capitalization structures, it's kind of similar to a plane. And you have your first class, business class, economy, economy plus, and each of these classes are certain types of certain parts, certain types of capitalizations or certain types of assets that are used to capitalize a company. So I think equity is thought of as economy, economy plus, so that's your common stock, preferred shares. And then you have your, I think, bondholders that are business class, and then your senior secured loans, which I think are these leveraged loans that PitchBook is talking about here. That's in your first class. Okay, so how does he explain?
Depending on which class of ticket you buy, you're going to get treated a certain way. Depending on which ticket you've bought, you get to choose your seat in certain sections. Now, equity and debt instruments are a bit like airline tickets. Depending on which class of ticket you buy, you're going to get treated a certain way. Ooh, thanks very much. And when it comes to getting off the plane, you're going to get off in a certain order. Shareholders, both ordinary and preferred, are all the way back in economy and economy plus.
Economy and economy plus. Okay, so this is BUFN. Shit. Change these to credit. Oh, I already do have a credit one. Okay. Okay, so let's say this. How is... I don't know what's... I should add this in maybe investments. Not too sure where I should add this, I'm gonna be honest. .1 investment concept. Yeah, I don't know about investments. I think maybe. Let's see what's in valuation. Free cash flow. Okay. I'm gonna just put it in credit for now then. And then, so how is all our debts and equity instruments like tickets on an airplane? So, in relation to a company's capitalization structure. So, source, I think this is PitchBook video on senior syndicated loans by Patty Hirsch. Okay. An airplane is like an airplane has different classes of tickets. So you have your first class, business class, economy plus economy. So with an airplane, we can think of debts and equity instruments as tickets, as classes for a similar. We can think of debt and equity instruments as classes similar to the tickets above. So first class would be your senior secured loans. Business class would be any type of bonds. Third, so economy plus would be your preferred shares. And then just economy, so equity. I guess you could say common shares. Each of these instruments are treated differently by the company. The debt instruments are higher class compared to the equity instruments, meaning that when the passengers board and exits the plane, and this in corporate terms, when the company decides to liquidate its assets, then the senior secured debts holders get paid back first, then the bondholders, then the shareholders. Okay, so how are debt and equity instruments like tickets on an airplane in relation to a company's capitalization structure? And so Patty Hirsch described it as different classes of tickets you can buy on an airplane. So when you think about whenever you're buying tickets for an airplane, you have different types of classes. So there's first class, business class, economy plus, and economy. And this is very similar to how corporations operate and how they think about their capitalization structure with debt and equity. Usually we can think of senior secured loans as the first class on an airplane. And then you have your bondholders, which are business class, and then economy plus and economy can be seen as the preferred and common shares. And the reason we can think about it this way is in an airplane, different classes are kind of treated differently. So first class are treated very nicely compared to your economy class. And first class usually is the first to board and first to leave the plane. And so I guess in corporate terms, when you think about how companies liquidate their assets and pay back their shareholders and debt holders, usually it's the debt holders that are paid back first, and then you have your equity holders that are paid back last. And so that's very similar to how airplanes operate. Okay, I actually really like that analogy.
First class passengers, they are prioritized. Next to get off and get paid, the bondholders. And finally, by collateral, That could be assets in the company, or it could be part of the company itself if it comes to a liquidation. But the combination of seniority and security mean that these loans are much less risky, and the lenders will probably get all or most of their money back if things go really badly wrong with the company. I say probably because senior secure lenders can still suffer significant losses. I mean, for example, if a company's entire business model goes down the tubes, like with VCRs back in the day, well then everybody's going to lose. It's all about risk and reward, right? A company's senior secured loan is less risky than...
Okay, that's cool. Okay, so yeah, this is interesting because I feel like leveraged is such an ambiguous term. I've never fully understood what's considered a high amount of leverage. So I guess in this case, so some people use a spread cutoff. Okay, I wonder what the base rate is, like some type of 10-year treasury yield. I'm not too sure. Okay, there's also any loan that's rated less than investment grade. This is defined as leverage. Wait, what is LCD? Right, page book. I guess this is some. Oh, leverage commentary and data. Okay. Growth rates, par amount since 2018. That was share. Okay. Okay. Private credit refers to a loan made by an investor or a non-bank lender, traditionally to small or mid-sized companies. Something used as a broad umbrella term that includes other types of loans such as distressed debt, mezzanine finance, and real estate loans. Let's see. Market is often called the broadly syndicated loan market, or BSL. In contrast, private credit loans can be provided by a single lender or by a group of lenders, though typically a smaller group than in a syndicated loan deal. Okay, so I think loan arrangers then are going to be, let's say, like the lending institutions, banks, that serves as intermediaries between the company that is wishing to borrow and then also investors that are wishing to provide. I guess investors and lenders are in the same category because they're the ones that are actually providing the capital for the company itself. And then your arranger is kind of the middleman that is arranging the syndicated loan. Okay.
It to effect a management buyout of the corporation. But probably the most frequent use of leverage finance these days is when a private equity firm uses it to buy a company. So let's focus on that one. And let's meet our private equity player, also called a sponsor. Money is bought using debt. And we're not talking about a little bit of debt here. What they're going to do, they're going to borrow that money. And where do you borrow money? From a banker. This is Billy the banker. Now these days, banks don't lend anything like that kind of money. Instead, they provide certain services. They act as a conduit between the borrower, the private equity firm, and a bunch of other investors who want to lend to the firm. Now this is called arranging a loan. The bank might also commit to underwrite the loan. This is when it guarantees that the private equity firm is when it to a loan. The bank called who want to lend to the firm. Of other investors who want to lend to the firm. Now this is called arranging a loan. The bank might also commit to underwrite.
What does the broad syndicated loan markets refer to? The syndicated loan market refers to the the syndicated loan market refers to the structure of arrangers and lenders. That's loan arrangers. So these are going to be banks and investors. Lenders. So I think these are going to be private equity firms, insurance companies, pension funds. What else are there? Insurance companies, pension funds. That's syndicate creates syndicates, so collection of lenders that lend to a single organization. So it seems like the syndicated loan market refers to the structure of loan arrangers and lenders that create syndicates that form a syndicate to lend that lend to a single organization. And lenders form a syndicate. Hello? Yep. 现在在特里的学校呢。没有。Yeah，只有一个人。Yep。20分钟。Yeah，休息呢？这。No，他们这儿挺热的。没事，今天有太阳，外面挺热的。Yeah。Yeah，说了没事。Yeah，明天下午。嗯哼。嗯哼。Yeah，你们，我吃了早餐，没有吃中午饭。也等一会儿吧，现在不是那么饿。晚上Tony 要接我，我们可能一起在这儿转。It's nice。昨天走了挺好的，我觉得你们会挺喜欢。那我爬了有一点，我不是爬，但是我走很多那些 hills。Yeah。我走的时候一直在 sidewalk 上走，有路。走没有多，车有可能还行吧。我觉得你不在马路上走，你也不，我就没有在马路上走。我就在。Yeah. So that's nice。我没有看到，但是我觉得可能8、9个。我 total 好像1点2点开始走，然后我5点半6点到饭馆。晚点了1个小时。Yeah。Oh shit。Yeah. Yeah, it works. Yeah. Okay. Oh yeah. 我要拿回来。
A bunch of my other friends that are from Seattle are going to.
Okay, sounds good. Yeah, sounds good. Alright. I'll see you later. Bye. Shit. So what is private credits? So private credits refers to the market for investors lending directly to organizations, bypassing arrangers, loan arrangers, and broadly syndicated loan market. Bypassing loan arrangers and the broadly there are multiple, so there can be multiple investors that lend directly to organizations. Private credits, but usually smaller than the size of a traditional syndicate. Various investments, credit funds, collateralized loan obligations, subordinate accounts. What is the unitranche loans, which combine senior and junior debt into a single debt facility? This compares to more complex. First and second lien loans are junior and senior and junior. I guess this is kind of going back into the airplane ticket metaphor or analogy, where it seems like syndicated loans have different structures within structures. I guess you could call these tranches. So there's different tranches that affect the seniority or the ability, or I guess the claims on the ownership of assets. What is Covenant Lights? One place this is evident is in BDC portfolios. What's a BDC portfolio? Taken up. Expensive syndicate. Wait, so it seems like private credit is already higher than the broadly syndicated loan market, so I'm not too sure. Okay. So I guess private equity and private credit kind of go hand in hand here with I feel like these rating agencies governing transactions within the syndicated loan market, I would feel like it's kind of a safeguard for risk of default. And so when people are bypassing this, it seems like it's kind of a red flag. And private credit loans can close more quickly than syndicated loans. Close in a little few days for repeat borrowers. Wow, so why does it take so? Is there like a quicker due diligence process with private credit loans? This is a really long article. Wow. Sponsor. Mutual covenants. Oh, I feel like these are. Okay, so those are nice, some nice definitions. Okay, so I think this is definitely worth going through. I'm probably gonna spend a little bit longer actually reading through this. The leveraged loan primer. Okay, so I think I now know what syndicated loans means. So these are loans that are formed by a group, usually called a syndicate. These can be any types of corporations. So it could be, let's say, investors of pension funds, private equity firms, mutual funds, insurance companies. That form syndicates of lenders, and usually it's a bank or that's arranging the loan or arranging the syndicate. Okay. Unit tranche. Pari passu. This could be interesting to read through the swaps here. Okay. Okay, so what are tranches? So it seems like, debt tranches refers to the collection of bond/debt instruments that make up a deal, financing deal / capital structure. ABCs of asset-backed securities. Okay, so I think these are like different classes of debts. Okay. Refer to collection of bonds. Financing deal. Bond/debt instruments. So tranches usually are split by the risk of the debt instruments. For example, so different tranches for example, creating different tranches of debts for secured senior and junior debts, creating different tranches of debt for secured and unsecured debts. So what are debt tranches? Debt tranches refer to the collection of bonds instruments that make up a financing deal / capital structure. So tranches are usually split by the risk of the debt instruments. For example, creating different tranches of debt for senior and junior debt. Okay. Secured and unsecured debts. Right. Nice. So I'll add this into the interesting resources list. Interesting. Actually, ABCs of AB securities. For resources, all right.
You're going? Yeah, I'm gonna do well. You too? Yeah. Oh, sweet. You're like an Airbnb or you got it from like the with the club. With the club.
Yeah.
You're one of the lucky.
Yeah,
No, I just rented but like
So, are
You're going on Thursday or
the difference?
Friday, serious. Okay.
Yeah, she needs to work.
Absolutely.
Yeah, like Saturday.
What are the differences between privates,
Cabin party, and then Saturday,
credits?
open bar.
You're like one of the board and then
Yeah.
nice. Cool.
I'm planning a trip.
I need like if I want to
What are the differences between private credits
Yeah, it's
pay more
there's
so
a
like
social ticket.
and
And that's $80. So it's kind of expensive, but the
between loans originated from
3 hour open bar,
the
bowling, snacks, dinner.
credit markets and
That is Saturday.
syndicated?
And then Friday night we're having a party with everybody at the cabin with alcohol.
Oh yeah. Maybe I can buy it through like the campus group.
Okay,
Yeah.
so usually what are the differences between loans originated from the private credit market and syndicated loan market? So, private credit markets. Some differences. So, private credit market loans are usually not rated by a rating agency. Market loans are usually not traded. Secondary markets, private. Call these PCM. Usually not sure. Usually held until maturity. PCM loans are usually unitranche. Usually just unitranche. Single tranche. Usually not rated by a rating agency. Usually held until maturity. Usually unitranche. Single tranche. Okay. So Caitlin's more expensive, more efficient. It's secured overnight financing rates. I think this is the replacement for LIBOR, right? By contrast, large, high-quality investment-grade companies usually forego leveraged loans and pay little or no fees for repayment. Typically, an unsecured revolving credit instrument that is used to provide support for short-term. Okay, so I think this is what I saw within VF's Corp capitalization or the capital structure, because they have, I think, a revolving credit facility with. I'm not too sure exactly who. Maybe JP Morgan or another bank. Let's see. They syndicate loans. Managers and acquisition. Seasoned leverage loan. Seasoned leverage issuers, in contrast, pay lower fees for refinancing and out-of transactions. So I think drawn down is probably the same thing as write down. Right. Let's see. Splitter to okay. Most leveraged buyouts are backed by a private equity firm, which funds a transaction with a significant amount of debt in the form of leveraged loans, mezzanine finance, high-yield bonds, or debt as a share of total sources of funding. Oh, this is something I remember we talked about in class, like companies, publicly traded companies that take on debt to then finance dividends. You know, I have mixed feelings about this. I forgot what the Yeah, I feel like this is a kind of suspect way to use loans, though. If you're not reinvesting into the business, you're just paying it out to equity holders. Which is still a lot. Wow. 200 billion. You know, that's not much, though, in terms of outstanding loans. Or is this being originated? I'm not too sure. It's not clear. Asset-backed loans that carry wide spreads. These deals often require time-intensive collateral monitoring. Special purpose vehicles set up to hold and manage pools of leveraged loans. Okay, this is kind of confusing. How the fuck is this a arbitrage vehicle? Generate equity returns via leverage by issuing debt 10 to 11 times their equity contribution. What does that even mean? U.S. quarterly collateralized loan Application issuance.
Excited about that, definitely something that I'm pursuing. And then the one thing about it though is, in order to start full-time, I have to be CPA eligible.
Okay.
And, we're graduating from UCLA this next quarter.
Prime funds. Total asset value of prime funds. Okay. Looking at this graph kind of messes with my eyes for some reason. But it seems like there are less assets. There are more assets moving out of these US prime funds, unless the value of the assets themselves are deteriorating. These funds. Ratings, collateral coverage, seniority, credit statistics, industry sector transmission, sponsor. Okay. Okay, going to need to use the bathroom right now. And then I think maybe after, I'm gonna probably go check out the accelerator downstairs, see what's going on. Sponsor 3.3 BMC software Lightscape. It's BMC software. Yeah, this is. I mean, this is pretty. This is a pretty substantial article. Default rates, middle markets. Loan markets. That's cool. High yield bonds. Wonder if they had high yield bond market. Back to top. Large finance. Okay, like pitch, book, LCD.
Yeah, they have a white coat. Yeah.
Oh, that's cool. With Fin Insights. Oh, okay, it's by Crest Free Trial. Oh man, yeah, it's crazy. Newsletter. Okay, I guess I can sign up for the newsletter here. I'm probably going to. Let's see. Oh, okay. Oh, never mind. 你 see, okay. Research Center. Okay, let's see if I actually got it though. Can't tell. American Apparel footwear situation. Geopolitics. Okay, that could be interesting to read. Yeah, there's a lot. There's a lot to read. Okay, yeah, probably gonna go use the bathroom now, and then hit up the accelerator, see what's over there, and then come back, and then read a little bit more. Probably start reading the, the Navigating Debt Crises book, and also go over some of the flashcards I was writing down earlier. Alright, see you for now.